Welcome to this monthly update. I'm Julia Lee, an equity strategist at Bell Direct. Well, April is traditionally the best performing month on the Australian share market, according to numbers back from 2000, with an average return of 1.7%. So how have we fared this April? Well, the good news is we've doubled almost the average return with a gain of 3.3%, and that makes it the third best performing month over the past 12 months after February and January. In fact, all sectors traded higher, so it was green across the board. The only exception was the material sector, which was weighed down by the iron ore plays after global giant Vale received the green light to bring back supply online in Brazil after the dam disaster. But the best performing sectors were consumer staples and tech, both of these sectors gaining more than 6% for the month. And around the globe, it was also a positive story. Some of the best performers included the German DAX, which was up by 7% for the month. We also saw the Nasdaq at all-time record highs, up by 5%. And Japan also up by 5%. Markets around the globe underpinned by a dovish Fed and also China fiscal stimulus showing signs of taking hold. And with the US trumpeting first quarter growth of 3.2% with rising inventory levels, fewer imports and surging government spending, it looks like the setup for the market is looking good. Unfortunately, we are now going into May, which is traditionally the worst ranked month of the year. We will see banks trading ex-dividend, which impacts on prices, and we are watching for half-year numbers coming out for the major banks. On the 1st of May, we'll be watching ANZ. On the 2nd of May, it'll be NAB. On the 3rd of May, it'll be Macquarie. And on the 6th of May, it will be Westpac. Banks are in an earnings per share downgrade cycle with weaker housing the key driver, which means downside risk. The outlook also looking soft, with rate cuts usually a negative impact on the banks. But on the flip side, it will be valuations and dividends which will act as support, and there's renewed interest in bank yields given that interest rates are likely to fall here in Australia. But of course, May is also an election month, so looking forward, and the odds for a coalition win are continuing to shorten. Labor still at a 1 to $1.33 odds, whereas the coalition is at $3.95, and any other party is at $530. The key is that neither party looks to hold majority in the Senate, which means reliance on crossbenchers, the key to passing election policies. But it does look like tax cuts are coming for low and middle income earners. The capital gains tax discount also due to move from 50% to 25% from the 1st of January 2020, with an exception for new builds. And of course, the cash refunds of imputation credits in focus. Also, increased healthcare spending and a cap for private health insurance. So watching those impacts on specific companies, as you can see in that slide. But in terms of asset allocation and strategy, one of the keys for domestic policy will be that the markets are now pricing in 2 interest rate cuts here in Australia. That means greater allocation to bond proxies makes sense, and also moving to neutral on banks. And also looking for opportunities to pick up building stocks and domestically focused stocks over the next 6 to 9 months. Having a look at some of the opportunities by sector and preferred stocks given the falling interest rate environment here domestically. In terms of the banks, preferring Macquarie. In diversified financials, having a look at Magellan Financial Group and QBE. In industrial, Sydney Airports and Transurban. In staples, Coles. In utilities, APA. And in the property space, Dexus, Goodman Group and Charter Hall, as we continue to prefer office as well as industrial property. We are moving into May, but with US stocks ending the month at all-time record highs and stimulus starting to take hold in China, the outlook for stocks is looking good. Of course, a key part of that is going to be bank reports and those half-year numbers coming out, but much of it is still about the central banks, with the key theme of don't fight the Fed still being key to market returns. I'm Julia Lee, an equity strategist at Bell Direct. Hope to see you next month.